Hello, and welcome to the Performance Leadership Learning Lab's Virtual Roundtable. Today, our session will be covering navigating the human risk in rollover equity and earnouts, and we're glad you're here. Before we get started, I wanted to cover a couple of housekeeping notes. The first is a replay of today's session will be made available to all registrants at the end of the week. And secondly, if you have any questions, please feel free to drop those in the chat, and we'll make some time at the end of the session for an audience Q&A. So let's begin with introductions. I'm Cynthia Kyriazis, the Chief Experience Officer at the Culture Think Tank, and I will be your moderator for today. I'd like to ask each panelist to share a brief overview of first their role and second their background. Alex, we'll begin with you, and then Bob, Lindsay, and finally Will Lindstrom. So Alex, you're on.
Hi, thanks, Cynthia. Sorry, I just joined like 5 seconds ago, but I got the one thing, which is that I should present myself. My name is Alex Garcia Ingresano. I'm half Spanish, half American. I live in between Madrid and Monaco. I'm the managing partner for the Avant-Garde Group. We are a financial services company and also holding. We participate in deep tech in general. Deep tech would be everything from biotechnology, which isn't exactly that. Within software, we do quite a bit of AI and cybersecurity, but most of our bread and butter is around robotics, defense, manufacturing, those sorts of industries. The services we perform are mainly like M&A, fundraising, things like that. We are present in Madrid and Barcelona originally, also Monaco, and we have operations in London and in Miami, where we'll be opening soon. So what I hope to bring to the table is a bit more background of the differences between European M&A and US M&A, like what works best and what works worst from both models, and hopefully that'll be useful. So thanks.
Great, thank you.
Thanks, Alex. Yeah, I'm Bob Dunn, Managing Director with GF Data and a partner in the PL3 and SageForge project as well. Excuse me. GF Data, we believe, is the best source for valuation and other financial metrics on private equity-backed acquisitions in the middle market. So we track private equity deals by direct input from more than 330 private equity groups that report deals on a quarterly basis, looking at deals with enterprise values between 10 million and 500 million. So sort of what we think is very much the middle market, but in some cases the lower end of the middle market. In addition to valuation information, we also track data on leverage and key deal terms as well. And one of the things that we do look at is both rollover equity and earnouts as well. So I'm very happy to be on here. I think it's a great discussion and one that's very valuable for the folks that are tuning in.
Thanks, Bob. Lindsay.
So I'm Lindsay Gazowski, CEO and founder at The Crucible, and also a partner in the PL3 SageForge enterprise. The Crucible is an executive assessment that's predicated on the traits and behaviors most important in the private equity and investor-backed spaces. We can test individuals and teams for the purpose of diligence development and identification of appropriate leaders to help drive value within these organizations. I have, prior to The Crucible, nearly 15 years experience in executive search and being on the deal side in private equity. And I also sold a business where we had some rollover equity. So I can talk about this directly from that side as well.
Very good, thank you. Will.
Yeah, my name is Will Lindstrom, and I am the CEO of the Culture Think Tank and also part of the PL3 and the SageForge product development. And my background is primarily has been in turnaround consulting about how to optimize and transform companies and prepare them for growth, largely by looking at taking qualitative information and transforming into quantitative information. And what I'm excited about, what I've been working on with Bob and Lindsay, is about how to help prepare companies in the small middle market space, get ready in the pre-due diligence phase and get everything aligned so that they can successfully exit And so this should be a fun conversation to learn more about rollover equity and all those types of things that happen in the due diligence process and can make a deal successful or fall apart.
Okay, thank you, everybody. That sounds fascinating. I wasn't even sure what it was about. But it sounds pretty interesting to me. Okay, so we're going to start with Bob. We're going to put you on the hot seat with the first question, because I have several. So the question is, what trends are you seeing in the use of rollover equity and earnouts? And the second question is, what's the biggest financial misconception that founders have about rollover equity and earnouts during a transaction?
Yeah, so I think it's a great question on it. And, to start with it, I think earnouts and rollover equity get lumped into a similar category by many people because you're deferring part of the purchase price for a future payment up there, but they actually serve two different purposes on it. Rollover equity is very much about alignment of interests, making sure that that management team that you're bringing on is working toward the same goal, which again is a successful resale of the company in a 3 to 5 year period if you're dealing with private equity. And the rollover equity makes sure that those managers that are on there are, one, going to stay with the company for the full time, they have skin in the game, and two, that they have skin in the game and that they're working toward that successful exit in lockstep with the investors that have come in on the company. Earnouts, on the other hand, while it does align interests to a degree, are generally more of a valuation bridging mechanism. Seller believes company is worth X, buyer believes company is worth X minus Y. The earnout can go in there to fill that Y gap on it and allows the time series on it. So the management team saying, hey, we didn't do it this year, or we expect to get to this point. That's obviously contingent on what happens in the next 6 months, the next 12 months, the next 18 months. The earnout allows for that, where a lower purchase price is done at the time, but getting to that full purchase price the seller wants to get to is done via certain conditions on the performance of the business. And those conditions will vary on it. So in the case of rollover equity, very common in what we call platform investments. Platforms are the companies that private equity acquire, and they use it as a base to make additional acquisitions and kind of grow off of the companies they acquire off of there. We can call add-on investments. And generally the dynamic there for an add-on does not favor as much rollover equity, because oftentimes those folks that own those companies are not coming on for the full ride on it. They're going to basically sell their company and have a 6 to 12 month period, but they're not a crucial link in it, whereas the platform is really the base of what they're doing for investment on it. In the case of platforms, for the first 2 quarters of this year, a little over 73% of deals included rollover equity, and the average on it was about 15.5% on that. It's interesting to note, as you go up sized tiers, and we classify the data we provide into 5 size tiers: 10 to 25 million, 25 to 50 million. This is all enterprise value. 50 to 100 million, 100 to 250, and 250 to 500 million. You'll see that percentage of rollover equity going up with each size tier on it. So when you get to the 250 to 500 million total, above 20% is not uncommon to see on it. And again, it's a very common aspect of most transactions for platform investments, again, for that alignment of interest. When you look at earnouts on it, historically, we've tracked about half of deals including earnouts on them. It's definitely a thornier proposition because you don't actually have an ownership stake in the business. You have certain conditions on the performance of that business or your individual performance that will unlock the additional amount tied to that earnout on it. But it's definitely a lot more speculative, a lot more tentative, and a lot more dependent on the relationship between the seller and the buyer on it to make sure that, you like each other, you respect each other, you want to work together on it, and that you can take the buyer at their word on it, which I would say for any transaction you're doing, you want to be able to do that, but especially important when there's an earnout involved and you want to make sure that the chips don't get moved on you once you've already agreed to the deal. Anecdotally, I'll say, in talking to lawyers within the space, probably about half of earnouts end up in litigation on it. So it's definitely a lot more speculative than the rollover equity side. So that's a little bit of background. In terms of trends, I think rollover equity, the use of it is definitely increasing. Again, prior years, I think number was probably pretty close to it, but I've seen the percentages allocated to rollover equity going up. And again, a lot of firms that we deal with, they want that high level of rollover. No one wants to sacrifice any of their own equity on a deal, but that alignment of interest is key, and making sure that there is a huge incentive there for that management team to see through the transaction to its next point of sale. And really be in lockstep and really pushing for that period. Because again, we only deal with private equity. Most investments have a 3 to 5 year time horizon. So time is ticking very quickly. You need everyone engaged. You need everyone worked in the same goal. And it's a great mechanism for it. In terms of earnouts, we've seen more of those also. across the last 3 years. We've had another number of dislocations within the overall middle markets and broader financial markets. You had sort of the long tail of COVID coming out, which up until last year, you still had questionable financials being presented that were maybe in some way impacted by what happened during COVID. You know, some companies saw major earnings growth, some companies saw stagnation, but the trust in those post-COVID numbers was not necessarily there. So you'd see earnouts come in as a way to say, okay, you believe the company is going to recover, improve performance. We have questions about that, but it's a way to meet in the middle. The same side of it, going through other issues, the lending environments from 18 months ago, which are still challenged, but not as much as they were on it. That's a situation where possibly private equity wasn't going to be able to get the amount of debt that they wanted on the deal. So an earnout could come in there to give a lower valuation at this point in time, but then the opportunity for that additional valuation once those conditions are met on it. So both of them very much front of mind in the marketplace. I think seeing a lot on both of them, and they're definitely something that sellers need to be aware of. But I think the differentiation between the rollover equity and the earnout and what they're used for and what they mean is a key thing to keep in mind from the seller's perspective.
Well, and just one quick addendum to what Bob said there. In the deal that we had both rollover equity and an
Yes.
earnout. And our lawyers told us that we should consider an earn never, not an earn out, that the speculative nature of that, in part because how it's structured, you can agree on the front end, but when rubber meets the road, it sometimes doesn't work quite as well as your optimistic projections or the way you would have run it if you didn't have another party involved. I think one of the things with rollover equity that people are seeing in this extension of hold periods is that returns that you thought might be coming to you in 3 or 4 years, per the promise of hey, we've got this great platform, and you're the second company, and we're offering some rollover equity, or you're the platform and we intend to sell this in 4 years. It's now 6.
Yep.
And so it's trapping some of your liquidity that you otherwise would have had if it had been an all cash opportunity. But the upside in theory is a lot higher because you're banking on the idea that this platform is going to grow and that money that you're rolling over is going to see that same increase that other investment would.
Yeah, and I think that's an excellent point, Lindsay. That the hold periods have definitely extended out, like you said, 6-year average now, and now historically 3 to 5 is the target on it. I think that's, as with most things, cyclical, and we'll see those hold periods go back down. There's huge LP pressure to get some returns on it, and obviously the investors or the private equity groups managing those investors' money want to get money back to them, but it has been a tough period for some of the reasons I mentioned earlier on it. The markets have been choppy on it, but yeah, you are locking it up for a longer period of time, and that's something to be taken into account on it.
Wealth of information between the two of you, for sure. Thank you for sharing. But Bob, as usual, goes very deep, and Lindsay always has something to add to it with value. So no pressure, Alex, but you're on next. How does the approach to rollover equity and earnouts differ between the US and European markets first? And secondly, do you see one as better than the other?
Okay, so as a general rule of thumb, I'd say, and well, Bob has more data than me. He might correct everything I say today, but I'll try. Basically, rollover equity is a bit more common in the US versus earnouts, which is more common in Europe. There's a lot of reasons for that. Basically, I'd say an important one is that US financial markets are just more liquid than European ones. So valuations are generally higher in the US, but in Europe, like founders, of course, want to get like their, that higher valuation. They've seen that exists, and they go in and so a lot of the times the agreement is that. Also, European founders tend to see private equity as an exit, almost as a safety net, versus US founders who see rollover equity as a way of making money twice on the deal. So I'd say European founders tend to sell much later, very close to their, to retirement versus US founders who there's a certain culture where selling a company is just more common at a younger age in the States. So American founders are willing and happy to, to say, okay, let's stay, not only stay on this company, but also, try to get more of an upside twice. Um, so I had the one thing also that I have the same data as Bob is that about 50% of earnouts end up in litigation. That's in Europe. He was saying in the US, so it's pretty similar numbers. Um, I'd say there's a number of reasons for that. The the thing is founders tend to do things a certain way, and they're expecting some EBITDA results, which they see as more or less objective, and so they have some expectations. They feel they reach certain numbers, but they have to take into account that they're the chief financial officer, the private equity firm that's coming in. Might calculate things differently. They might adjust things differently. And there's been pretty large fallouts. I think in Europe there was a large one with between HP and an Italian company that was very, very well known because they spent a long time in court. And I can't even remember who won, but that's something that's not that uncommon in Europe. Earnouts tend to be more financial based. Rollover equity. I've seen cases where it tends to be a little more open, like the incentives for that type of structure, because sales can happen under other cases or like company growth. Maybe if you're in biotech, which we're very involved in, it has to do with getting past a certain phase, a certain trial, things like that. Whereas earnouts are almost always financial. That's the at least the cases I've seen. Um, so what's better, what's worse? I think it depends, at what stage of your life you're at. It depends on a lot of variables. You just have to know what you're getting into. And I would say more than anything, which is the same thing I would tell, when I was doing pre-seed and seed stage investing up until like this stage of M&A and private equities, which is you really have to do diligence your buyer really well, because generally of course private equity firms can get into litigation just once, but what I've seen is that there's certain private equity firms that tend to get into litigation more often than others. So anything that's a promise of future revenue but under whatever it is, you have certain partners that are more dependable for that. And so what's better or worse depends on each individual case and on each individual buyer, but it takes a lot of work on the part of the founder to do their proper due diligence, and that's what I think that founders sometimes forget when they think of like multiples, dollar amounts, things like that. That's definitely one of the things to take into account. But I think due diligence is more important than when you've done it like more than once. Like, Lindsay was saying, I think that you probably have that experience.
Hey, thank you, Alex. That was very interesting. And now we're going to move to Lindsay because I am curious about this one. How can buyers structure founder retention in a way that maintains trust and influence without creating tension or micromanagement?
And I think on the front end, it's really important as you're going through the selling process as a founder to understand what you're looking for in your buyer and try to find a fund that's going to align with that. So if you want to be able to run the company without too much oversight, which doesn't always happen in private equity or very often happen in private equity, you need to find a fund that is aligned to that and is probably going to give you larger earnouts and less cash up front in an effort to incentivize you in that way. If you want someone who's going to provide a lot of structure or that can create opportunities in other respects, find that kind of fund. And so when you're going through the sale process, really ask a lot of questions as a seller around what does this relationship look like day one, day 60, 6 months in, 2 years in? Do you intend to professionalize this management team and build around me? If I'm a seller who wants to make it to the next exit, is that something I can expect? Or should I plan for being moved into an advisory role? And having that understanding as to how the fund likes to work with their management, even through the, sale diligence process, you get yourself to a good place where you've developed a relationship where you can say, okay, here's my high level expectations culturally and structurally. And then it's getting into some of the details around how are we being incentivized? Are we being incentivized based on a core set of definitions and numbers that we've all agreed upon up front, which minimizes some of that risk of, a new CFO calculating things in one way and the existing financial team calculating in another way? I mean, one of the things in our earnout, I had historically, because I was the de facto CFO, had calculated our cost of inventory in one way because they had a group purchasing program with the new private equity owners. They calculated in a different way. And so there was a discrepancy between those that would have gotten us more EBITDA done in my way, simply because we didn't have this pool of inventory we were pulling from, and we were calculating things based on what we physically had in the shop. That wasn't consistent, but had we known how that was going to be calculated on the front end, no one would have had an issue with it. And so it caused some strife later that made some people a little testy, but we'd had such a great relationship that was built and structured because we'd gone through the whole process of understanding who we were, what our cultural values were, how we worked, what our strengths were as leaders, what the team was going to look like going forward, and what the fund liked to do in terms of how they would engage with the team to enable a really solid relationship going forward. Everyone knew what our roles were. We all understood who was going to stay and who wasn't, and what the succession plan was for those who weren't, in a way that allowed for open communication. So I think it's really important to define the critical terms of what you're going to be calculating, to establish who you all are up front, understand that fit between the cultural and structural values of the current company and of your new buyer, and understand what can change. Let's say you do a ton of add-ons. What does that mean for any of that information that you've already agreed upon? And so just having more information in these scenarios is always better. More definitions is always better, even if it feels like maybe you're not getting quite as much on the front end in those definitions. Having that clarity will get you more on the back end.
And I just add to that, I think those were very good points. And let's remember, not all buyers are private equity firms. There's a lot of corporate buyers, and I've come across a lot of even first-time buyers, second-time buyers, third-time buyers. So when I was referring before to the due diligence, and it sounds like, Lindsay, you were involved in a pretty good, at least transparent process. I don't know if you were all happy or not at the end, but very transparent. A lot of times asking your prospective buyer whether, what's the plan on the first day, what's the plan on the 100th day, what's the succession plan, what's the control, like who's going to be doing what, et cetera, et cetera. It's not just something which is nice to know. A lot of times you're seeing if your prospective buyer knows exactly or has like a very good and detailed plan. Now, a lot of times your buyer is going to be so strategic and so interesting in your industry that they're not going to have that level of professionalism which, private equity would have, because they have their own system and it's usually very crisp. I'm not saying refuse corporate buyers who don't have a huge amount of experience, but it's good to work both ways on trying to define very, very well what you're going to do, because you're basically, when you're selling to them, you're basically helping them build their system too.
It sounds very
Yeah.
much like in both respects, setting expectations. We've got to set the expectations up front. Yeah.
And just to add also on the different, types of potential buyers out there, even within private equity, what we're talking about here is largely the model of funded sponsors, which go out and raise funds, and they do that every 3 to 5 years generally as well. But increasingly, we're seeing family offices and independent sponsors out there. Family offices act like private equity, but they're generally, it's generally a family that's made money in a given industry, and they have quite a bit of wealth and have decided they want to go out and do direct investments, oftentimes tied to the industry where that wealth was created. But in those cases, you're removing that long-term or that short-term time horizon on it. They can hold the investment indefinitely. They could build it into a conglomerate. They could do a lot of different things, but that quick turnaround isn't there. So that's to be under consideration. And then similar independent sponsors, they are definitely looking to exit their investments, but they're not really on that 3 to 5 year, in this case, 6-year time horizon, because they can, they don't have to return the money within a fund structure in a certain period of time. They have more flexibility on it. So within private equity, there are a bunch of different stripes of potential buyers. And then also outside of it, as Alex pointed out, you have all the corporates and then, just folks that want to buy a business. So, but I think Lindsay's point of really doing your diligence on all of them and making sure, and Alex's point, and making sure that you feel good about who you're talking to on it. And it may not be the one offering you the highest price for the company. That's something you need to kind of separate out from this. And oftentimes it isn't, but again, you're going to have to work with whoever's buying it for a certain amount of time in most situations, and you want to be comfortable with it.
Good point. Good point from all three of you. Okay, so question number 4, Will Lindstrom, my cohort and founder. When a founder stays post-close, what reporting systems or structures support transparency and avoid disputes?
In this case, I think it ties back to what Lindsay was talking about. And I think some of them is making sure you understand from a financial perspective how things are being measured. I think that's the most important thing. As founders, many founders lead up to it, they're going to be transitioning from a tax avoidance or a tax optimization perspective in calculating their earnings. And then they're going to be getting into this adjusted earnings calculations where personal expenses, things like that. I know Alex can share kind of how this is done a little bit more deeply in Europe. This is a bigger problem in Europe, but a lot of these personal expenses are in there, and then it gets done into adjusted earnings. But traditionally, founders or consistently founders are doing this late in the process. So as a result, there's not a really firm understanding. They're just kind of all of a sudden in the last year organizing all their books to look like it should be, the profits where it needs to be, so that you're getting the most return. But that then changes the reporting standard, because especially a more sophisticated organization is going to come in and it's going to be very much optimized for profit demonstration. It's going to be optimized for all those types of things that the investors want to see. So in that case, that's where I think the number one issue is making sure you have a firm understanding of financials. And then the second thing that is really important for founders to do, and I'm hearing this consistently from different wealth managers that are working with them, as well as some of the certified exit planners that work with them, is that the founders need to have a clear sense of who they are and what they're going to do and how they're going to fit into the organization when they no longer have the keys to the castle. And that's the hardest part. So one of the we're working on like analyzing qualitative and quantitative. One of the key questions is, what do you plan to do when you transition? And if the founder says, I plan to golf, that's, how much can you golf, or how much can you fish before you're going to get bored and before you're going to start to feel like you don't belong, or you're going to want to do more. And maybe the buyer doesn't want you to do more. The buyer just wants you to be in this role. But having a clear understanding and having clear expectations between what the buyer expects you to do and what you want to do is important. And just to touch on one metric that I have is something around 76% of founders regret selling their company within 18 months of the sale. So that also can create this tension, because the founder's identity is oftentimes rolled up into the company itself.
I've
Wow,
seen, Will, just to your point, just an anecdote where this year I've seen a transaction, worth hundreds of millions of euros, where the founder, after completely selling his company, would go into the office every day. And the transition team was like, we don't know what to do. I mean, we don't want to kick him out, but we'd rather he didn't come in. So yeah, that is a good point.
Great stories. Great information from all of you. So now I have an open question for all of you, which tangentially touches on some of what you said. So here's the question. Can you share a real world example where rollover or earnout were successful, and then one where the story that wasn't as successful, and explain why?
So I'm happy to give my real world example on both fronts. So the rollover piece, we were allowed to roll 10%. And that was pretty solid for us. The business is trending well. There were additional acquisitions made. The size of the business has grown. And so the value of that rollover equity expanded substantially. They are looking to go to market toward the end of this year, which is exciting. And enables, I think, real wealth creation for all of us who had that opportunity for a rollover, which is something that I think kept us engaged and kept us on a positive front with everything else happening, especially as I get into the second half of the story, which was in the earnout. They offered the same multiple on any EBITDA created in the year after sale. And we had been growing. Our CAGR was something like 35%. So it was substantial. It was a home services business in the post-COVID era. So it was a really excellent opportunity to continue growing. And our plan was to use that earnout money to help incentivize the workers who didn't have a bite at the apple the first time around. And again, calculations were done differently on inventory. They added a number of layers of management that hadn't previously existed that were detrimental to EBITDA. There were some other components of accrued revenue versus cash that were treated differently. And it yielded about half of what we were expecting, even based on the numbers and the calculations we'd agreed upon. And so it was a scenario where if we didn't have the rollover equity component also tied to this, and the good relationships that we'd established through understanding the transition plans and picking the fund that was right for the fact that I was going to leave pretty quickly, the CEO intended to be there for 18 months, and then transition to our COO as the leader. If that hadn't been a fund that was supporting all of those elements, we also could have been one of the statistics ending up in court. Instead, we agreed that, yes, technically everyone had followed the right rules, and we would distribute more to the guys that were working than to ourselves in that scenario, to keep them as whole as possible. But it could have gone very poorly had there not been that established trust already.
Anybody else have an example? Does anybody else have an example?
Just a little bit to my point before, I can't speak to examples that come from firm I'm involved in, but when I was much younger, I sold a company to a corporate in the healthcare space, and I did an equity deal. And one thing that was challenging for me, even though I had a board seat at the new company, was understanding that I was suddenly a very small part of a very large corporate strategy. And the company that I exited became a business unit, which ended up being closed down because it just didn't fit the overall strategy a few years later. That didn't make my equity disappear in the larger corporate. It's just made my role a little bit unnecessary. So this point taken at a larger level just means that even when you're joining a private equity firm and you're talking about a company that's or has been fully yours, you also have to take into account that you are suddenly part of a portfolio, you're part of a larger a larger strategy. And sometimes the things that you have operated, the ideas you've operated under of what's best for your company and what's best moving forward suddenly get put within a context which is not the context that you're used to as a founder. So that's the example I can give.
And I'd say, Alex, I kind of coming off that, and this was many, many years ago, but was employed at a portco in the media space that was doing a roll-up strategy, business media actually, and all went well, and I don't think there were challenges on it, but when we were acquired, the acquirer only acquired half the company. So, that half got realized and got taken out, but then the rest of the acquired businesses were still in this holding company that was kind of sitting there, left a little bit lame after losing the other parts. Now, it made sense to do it. The businesses were acquired were all within a specific sector, specific space. They all fit together, and possibly putting them together with the other companies. I mean, they're all financial information businesses, but different a bit. But that is a possibility you need to consider on it there, that there may be, a carve out of the business that you're coming into, or it could get shut down, as you said, or, anything can happen after that. And the path often isn't clear on it. So to Lindsay's point, trying to get as much clarity on what that path looks like at inception of the deal or during diligence of the deal. It will change afterward, but at least you have a map to go on, versus kind of discovering it once the deal closes and finding this stuff out after the fact.
Very good. So I have another question for all of you that I think our listeners will be interested in. The question is, what do you think will change most in how earnouts and rollover equity are structured over the next 3 to 5 years? And are these shifts in regulation, tax, or market behavior that you might see coming?
I think you'll see the percentage, maybe not the frequency, but the percentage of rollover equity declining over the next couple of years on it. We definitely saw an uptick when the debt markets were more troubled. It was, it's not the preferred way to get a deal done, but if the bank's only willing to lend you X, doing a rollover equity side or earnout side could possibly get the deal over the line. So I think you'll see the percentages come down a bit, probably the frequency come down a bit, but it's a very common aspect of at least the private equity deal marketplace. But it did hit a high point, I think, middle of last year on it, and expected to decline, at least in the average percentages we're seeing going into transactions on the rollover side.
And I think if you also look at the trends that are coming out from the smaller side, if you're looking at from kind of the insights coming from the wealth managers, a large number of privately held companies that are going to be coming up for sale are going to align more like what Alex is saying. And these people are at the end of their careers, because I think it's about 60% of privately held companies have a founder that's 65-ish years of age. So they're not going to be wanting to hang on for 5, 7, 10 years. They're going to be looking to exit a little bit more quickly. So I agree with that. I think it's going to come down. Now, I don't know on the earnout side. I think that's going to be case by case, but I think on the rollover equity side, that's going to happen.
Yeah, and I'd say just on that point, Will, JP Morgan did a study. I think it was a couple thousand business owners on it. 90% of them said they were looking to exit within 3 years of their business. And I think the majority of them fall into that camp you're talking about. It's not serial entrepreneurs who are, middle of life. It's generally folks who are older. They've had one business their whole life. They're looking to get out of it now. And when they say get out, they want to get out. The other thing to take into account, again, those disruptions in the market starting all the way back from COVID on it, you have a pipeline that 2021 and 2022, there was a lot of activity and a lot of deals going on. But since then, it's been relatively slow in terms of transactions happening. So that's built up the demand within that cohort that you're talking about, the folks. And, if you're a young entrepreneur on it, you probably don't want to wait, but you can wait a bit. But if you've already put off and you're, a person who's had a business for 40 years and it's 5 years later than you're expecting to exit, there's a lot of pressure on there. And you're right. They probably want to get out entirely and not continue on at this stage.
That is a good point. And I think that even more than that, or in addition to that, I think that what I see, and the older the founder is, the truer this is that the speed of the transaction is very important. Even more, you would expect like maximize the financial value. This would be your North Star. But more and more I see like especially with older founders who are not only looking to do a full exit, but they're looking to do a faster one. When you were saying that, JP Morgan, what was it? A lot of founders were expecting 3 years to exit. It means
Yep.
that they want the negotiations to be fast. And in order to win deals, I feel that private equity firms have to have like a very, very crisp process of, what they do and how they work, how they diligence, and how they close a transaction from the time that they see a deal to the time that they convert it.
And I think for private equity funds that want to use some of these structures as a part of how they're doing the deals, and particularly if they can't get the full value of cash to buy these things, it might be more for them about reframing what these things are. It's an opportunity for, a 65-year-old founder who's selling is likely to still have 25 years to have to use that money in retirement, right? So if this is an opportunity to be a part of their portfolio of wealth management strategies as an investment in a private equity-backed business, well, maybe that's another way to think about it. Or the earnout is a way that, here's a dollar figure, but we're putting this out there. You're not going to be a part of it, but if the business does this, here's an extra kicker for you to go with us. There may be some reframing that happens over the next few years.
And it's both sides on it too, right? I mean, definitely private equity should do it, but from the seller side, I think there's a fixation on the headline number, right? And it's okay, I'm going to get this, and a lot of that comes from, anecdotal. I mean, no one at the country club who's talking about selling their company says they got a crummy multiple on it. I think everyone puts some exaggeration on it, and but that creates an expectation that becomes a fixation, and it's really, it is one aspect. It's a huge aspect, but again, different structures, different approaches, having the right partner. It's not always that headline number that is the thing that's going to make a really great experience and a great deal on it. And I think taking into account too that headline number can be made up of components. And if you're confident in the components and confident with the partner on it, it is a way to diversify on it and kind of keep that revenue stream coming on it well after the sale.
Okay, so I have one final question, short answers, we hope. What advice do you give to buyers? And I'm going to change this to read, what is the one piece of advice do you give to buyers looking to create alignment from the first conversation and not just the term sheet?
Well, I mean, to our point before, I think most of us would answer that it's a lot of those operational questions. I think giving a very clear path of what's going to happen on day one, what's going to happen on day 100, what everyone's roles are going to be, and how we work and how you fit into our strategy. That's those are the most important questions to ask.
Okay, any other comments? All right.
Yeah.
Well,
just very quickly, also just be honest with yourself as a seller. What are you looking for? And as a buyer, what are you looking for? If everyone has that honesty up front, the processes are a lot of dating, and people can become different through that process or focus on the wrong things. And so maintaining that anchor as to what you want as an outcome, I think is really, really critical.
really important. Very good. Awesome information from our experts today. Thank you for joining us. Thank you to the panel for their expertise and their knowledge. Thanks to the audience for joining us today. We hope this conversation shed some light on a clearer understanding of earnouts and rollover equity and how they could shape a better deals and stronger outcomes. This roundtable is part of a monthly series from the Performance Leadership Learning Lab, where we explore topics like leadership, organizational performance, AI, cultural alignment, and investor decision-making in greater depth. Next month's topic will focus on performance technology with a session entitled From Blind Spots to Buyouts, How AI Standardized metrics are transforming due diligence, and we do hope you will join us for that. To learn more about us, please visit the PLLlab.com, and we'll see you next time.